Okay, welcome to Wealth in Public, episode 8. What we're going to talk about today is being in the red, losing money. Nobody wants to do it. The stock market sucks when it's losing you money. Let's get into it. First things first, we're in an environment now where tariffs have popped up, conflicts with other countries have popped up, and that has a dangerous effect on the stock market because things go down. People see different things go down. The dollar goes down in value. Different things like that happen, and the market goes down. Now, a good example of a market dip was actually April of 2025 when our administration announced the Liberation Day tariffs. That was my worst day in the stock market because my account literally lost about half of its value, right? And even recently, with our conflicts with different countries and what we've been doing in our administration's kind of back and forth nature in what's going on, my account has taken dips. It's come back up. It's taken dips, come back up. But it's a great time to really talk about what to do in the market dips. A lot of questions that pop up when you see red is you're thinking, what if it keeps dropping? Should I have pulled out yesterday? What if this time is different? I'm scared what's going to happen. All these different things pop up in your head, but it's really just your brain playing tricks on you. When you see a market dip, don't panic. Things go up, things go down. So don't panic. For me, what happened when the market has dipped recently, along with what happened in April, was I did get a little scared because I was like, dang, I've never seen this before. I've never been in this type of situation before. I haven't seen it. But when 2008 happened, I was a kid, so I didn't hear anything from the stock market. I didn't see anything going down. I didn't hear anything about the housing crisis. I didn't know I was in a housing crisis. I knew I had a PlayStation 2 and I was chilling. The 1929 stock market crash. It's like I wasn't even a thought in my parents' mind in 1929. My parents weren't even born yet, so I wouldn't know. These market dips are, when you experience these, just remember these are things that you probably just haven't experienced in your lifetime, which is okay because these things happen. And this is when we go back and we look at history, and then we go back and we look at the companies we're investing in, and we look at what they're still currently doing. So that kind of brings me into my next topic. Let's kind of break down what's happening right now. Right now, we have an administration that is very volatile. We have an administration that will put 100% tariffs on one country one day, and then a couple days later, they'll turn around and go right back to, we won't do any tariffs. So that up and down nature causes market fluctuations, which cause massive dips. Things rise. On top of that, our dollar is losing value. So our dollar is losing value. Gold's value is skyrocketing right now while everything else is falling. Our tech companies, people thinking about AI, all these tech companies, people are starting to not believe in because AI is not making as much money as they originally planned. Some companies are going in different directions. It's just, we're in a market fluctuation of so many things are changing right now that it's just companies have fallen. A good example would be Meta. Meta fell from almost, I'm going to actually pull up Meta's recent prices. So currently, Meta is at $672.97. Meta's high was $795. And that was in September. They fell, that was in September of last year. They fell all the way to $581.14. So what happens in that situation? And they've only come back up, I can't say only, they've risen to almost $100, but they've recovered just a little bit. And yeah, it's not like they're way up. Same thing with, let's look at Broadcom. Broadcom's a great example as well. Broadcom was almost $412 a share. They fell all the way to $332. Well, they fell all the way to like $314.01. and now they recovered to 331. So post market 333. So what do you do in these situations when you're invested in these stocks and they fall like that? Like, it's gotta be scary. For me, when I first experienced it, I was super worried. When I first, like April, I was like, I don't know. And I actually sold 3 of my shares of Broadcom. I bought it at $164, and I sold 3 of my shares of Palantir when I had it at $70. Both of those stocks are still way, way up. So one thing I can say is don't panic sell. Because when you see money come down, when you see that stocks are falling, when you see these things are falling, you're not losing money. Your stocks are losing value. You only lose money if you sell the stock. So keep that in mind. This is why we invest in companies that we 100% believe in for the future. So when they have these dips, we're looking and we're like, okay, should I buy more? Should I just hold? Should I stay? Maybe I add a little bit more to my position. Whatever that is, it is you decide. Cool. Let's get into a little bit of how what history shows us. In 1950, the S&P 500, it had a 5% dip about 3 times every year. And 10% corrections happen about once a year. And despite all these different dips, the S&P 500 still averages a 10% return annually over the long term. So even with that market dip that we had last year in April, the S&P still gave a positive return for last year. And let's see, what was the return for the S&P 500 in 2025? The S&P 500 delivered a total return of about 17.9% in 2025. And in 2024, it delivered a 25%. In 2023, it delivered a 26%. And then in 2022, it was negative 18. So we've experienced a dip. But what I really want you to understand is market dips are normal. These are normal things. We've had, in the past 4 years, we've had one negative returning year. We had a minus 18% year, and then we had 2 years of plus 20% returns. And then last year was a 17% return. So for one down year, you get 3 positive years. This is why we invest for the long term. So, translation, dips are normal. They're not the exception. They're part of the game. They're part of investing. They're part of things that come along with investing. So when the market is up, everybody's buying, everybody feels confident. When the market dips, everyone starts panicking and they all start selling at a loss. That's what brings the market even further down. But the market recovers and then everyone's mad that they sold. This is why I buy low, sell high. Most people, they panic sell because they're buying at the all-time highs of stocks and then they're selling it at a low. And that's really the opposite of what you're supposed to do. So you buy stocks when they're way down. So when they dip, when the 10% dip happens, the 20% dip happens, the 30% dip happens, the 50% dip happens, these are great times for you to purchase the stock. You don't want to buy NVIDIA when it's at an all-time high. You don't want to buy it when it's at $250 and that you hear all this news about NVIDIA hits a new all-time high. Because it's dangerous. Because the stock has to pull back now. There has to be some pull back. What goes up must come down. Newton's law. Simple as that. But you want to buy things when they're down, so when they go up, you're good. And then when you have a dip, it won't pull back that far. I can't guarantee it won't pull back that far, of course, because you never know what's going to happen. But still, if you're buying at a low, you're good. Perfect example is when I bought Broadcom, it was $164. Even after April's tariff situation, it did not fall below $164. So I actually sold the stock at no loss. I just didn't make any money either. Same with Palantir. It did not fall lower than $70, and I still sold it. And now Broadcom's almost $400 a share. I feel so stupid for that. Horrible idea. Mad I sold because I panic sold. But I did end up selling that to buy call options in Broadcom, and then that's a whole different story. But I still ended up making money off of Broadcom. But still, long-term plays. I love the long-term because that's where all the real money is made. So what am I going to do actually right now while we're in a market dip? What have I been doing while we're in a market dip? So, one, what I've been doing is I keep my regular investment schedule. Just because the market is down does not mean that my investments are down. I am taking this money. I still take my $700, my $750, and I put it in my investment account. Now, when the market is falling, do I put everything in at one time? No. Do I buy stocks all at one time? Absolutely not. I'll put a little bit in this stock, a little bit in this stock, a little bit in that stock, and then I watched my charts. I'm like, well, it's gotten down to a buy point for me. A good buy point for me is 30% from the high. Sometimes when it's 10% from its high. Sometimes when it's 20%, 15%. And for some stocks, I'm like, if it falls 5%, I'm dripping in a little bit of money. Then if it falls a little bit more, I'll drip in a little bit more. And then if it falls greatly, I'm like, all right, let's load up. So we'll see about how we'll see how that works. But usually when these prices are down, I actually can buy more of what I'm already investing in. So think about it. If Broadcom is $400 a share and I'm investing $700 a month, now of course I'm not going to put all $700 into Broadcom, but it's like, let's say I did. At $400 a month, I get a share and a half, maybe. But when it falls to $300 a share, and I put $700 in, I get 2.5 shares. See what I'm saying? You grow a little bit, and then as you continue to put more money in there, your shares, they get a big boost. So you think about it like that. Like when the market dips, everything's just on sale. Everything's good. Don't panic sell because we're invested for the long term. Don't panic sell. You're invested for the long term. So I'm taking that same amount of money, but I get more ownership, and that's the advantage of investing during a dip. I take the same amount of money that I invest every single month, and I keep investing that, and I just end up with more shares at a lower price for the long-term gain. Because what goes up must come down, and eventually the stock market is going to go back up. So keep investing, don't be scared, and don't sell it off. So another thing is, and this is kind of if you can, is that you can start increasing your investment. Now some people, they don't have extra cash just sitting around like me. I don't have extra cash sitting around for opportunities like this. So I don't got it. So it's kind of, my regular investment is kind of just what I got. But let's say, your grandma gives you extra $100, your family gives you extra $100, or you do some extra work and you end up getting some more money, whatever it is, you get a windfall of money. And now you're like, what do I do with it? Well, you can increase your investment. So let's say I invest $750 a month and I ended up, I have a good month in my business and now I have an extra $200-300 to invest. I'm put all $200-300 in there. And then I'll split it between which stocks I'm invested in. So, here's my plan for my $750. When things dip, I'm looking at indexes. So the first thing I'm putting is I'm taking 20% of it and I'm just going to keep it in cash because who knows, the stock market might go lower. Other things might happen. You never know. So I'm taking 20% and let me make sure I'm pulling up my calculator because I'm not that good at math. I use a calculator, guys. So 750 and I take 20%. $750 times 0.2. So I take $150. I keep that. That sits in the account. It sits on the sidelines just in case. Just in case. You never know. You never know. So with that, I have about $600 left. So I'm going to split that between 3 different things. 4 for me, actually. So I personally look at VOO. It's the Vanguard Index. And it's a total stock market index. So, of course, I want to be spread across the best companies in the stock market. So I'm going to put a couple of dollars up in there. So I'll put about $200 in there. $100-200. It kind of depends on, where that price is at. So I'll put $100 to $200 in there. And then I really love NVIDIA. I really love Google. I really love QQQ. So another index I'm looking at is QQQ because that's the NASDAQ. That's technology. Love technology. Technology is going to be the future. You see where we're at right now. Technology is not going nowhere. So, of course, another ETF, QQQ, I'm looking at, and I'm going to put $100 to $200 in there. Now, then I'm looking at individual stocks. What individual stocks do I love that I know for sure are going to be around? These are my Microsofts. These are my Nvidias. These are my Costcos. These are my my Visas, my TSMs, my Broadcoms, different things. But for me, I'm gonna just stick with one. I'll stick with one because I don't have that much money. I'm gonna go with Microsoft or Nvidia, or I'm going to split it between Microsoft and Nvidia. And now with those 4, I'm going to go ahead. I'm spread across technology with QQQ. I'm spread across the stock market with VOO, and I have 2 individual stocks that I really, really love. And that is the 2 tech, 2 index strategy that Ian Dunlap created. 2 tech, 2 index, no stress. I'm trying to tell you, it's the best to do. So I'll show you guys what I've actually purchased recently, and it's actually been Broadcom because I've been waiting a long time for Broadcom to come back down to get a couple more shares of that. But I've also bought Microsoft, Visa, Netflix, TSM, some VOO, some XLV, some Apple, and some Amazon. And I've just been consistently putting money into those. Bought a little Eli Lilly as well, a little more Meta, I just kind of split what I'm doing and I go from there. But what I'm not doing is I'm not selling any of my positions. I'm not selling anything. I lied. I sold one thing and I sold Coinbase. I sold Coinbase to roll all those earnings into stocks that I believe in more, but it's because I had Coinbase in my Roth. I don't want Coinbase in my retirement. So I took it out of my retirement and I put that same money into the stocks that I listed before. But overall, I'm not selling nothing. Ain't nothing going out of the account. No. And I'm not trying. The second thing is I'm not trying to time the bottom. If I see a stock coming down, I'm buying it. This is why I keep a percentage in cash, because I'm like, I don't know how low it's going to go, because who knows? It might get to $20. If I really believe in it, I got $20. So I might have to do that. But yeah, I'm not trying to time the bottom. I don't know if we'll ever hit the bottom. I don't know if we've hit the bottom yet. Nobody does. And anyone who says they know, they're a liar. So listen, I'm not waiting for the perfect moment. If I see it drop, I buy. If I see it drops more, I'll buy again next month. The next thing I'm not doing is I'm not investing money I need for bills. I'm not taking anything out my savings. I'm not taking anything out of my bill money. Nope. I stay regular with my investments. I'm not changing nothing. I'm not doing nothing extra. If some extra money falls into my lap, you know what I do. I keep 10% of it for me. The rest might get invested. I might split half of it to invest. It just depends on how much it is, but it is what it is. I'm not taking money I need for bills and putting it in the market just because it's down. It's not happening. No. And I'm not panic checking my portfolio every hour. I know when the market is down, it's hard to get up off your phone. I'm going to tell you right now, it's hard. I check my portfolio every day, actually. I check it every single day, but I'm not on and off of it every hour to make sure it's losing, to make sure I'm not losing. Nope. I know I'm in this for the next 10, 20, 30, 40 years. So whatever is going on today is going to go on today. And if I happen to get a windfall of money, I might go put some more in there. And that's really all I'm doing. That's really what I'm not doing. Now, the next thing I want to talk about is the emotional side. So I need to keep it real here, because it may feel like I'm just like, I got nerves of steel. No. Seeing my portfolio go down or lose any kind of value, I don't care if it's 13 cents or 1,300, 13,000. Watching my account lose any kind of value always hurts. Even though I know history and even though I know dips are normal, it still feels bad. And when you experience it, it's still going to feel bad. It's just a human response. None of us want to lose in anything. But here's what I remind myself with is I'm not investing for next month. I'm investing for the next 20 to 30 years. I'm not investing for a short term. I'm not investing for tomorrow. I'm investing for the long term. And I will continue to invest for the long term. And this dip that's happening, these negative moments are part of the long term. And I need to use this as an opportunity, not an obstacle. Because when I'm 60 years old, nobody's going to remember the January 2025 drop. They might. 50-50. You never know. But if I panic sell now, I'm going to remember it, because I'm going to be like, dang, everything dropped in January 2025. Or, dang, everything dropped in February and April, and I sold all my stuff. I still remember when I sold all my stuff the first time to help myself. And I'm just like, man, if I would have just held on to those shares, I would be way up right now. So just when I'm older, ain't nobody really gonna care about that dip that happened 45 years ago. Nobody talks about the 1929 stock fall. People talk about the 2008 crisis, but they talk about it as if last time the market was here, it was 2000. It was the 2008 crisis. It was the 1999 .com bubble. You hear about that, but nobody really cares because we're in the now, and we're looking forward. I'm not gonna say nobody really cares, but we're in the now, and we're looking forward. That's all. And last but not least, remember I talked about the racial wealth gap, right? Well, it exists partly because of market dips. People like us, like me, who have less financial education, less financial experience versus people with wealth and education, they know in these situations to hold on to their assets, buy more, and hoard those assets versus people like me that don't have as much money, don't have as much financial education, or don't have as much financial experience. They're going to sell everything because they don't want to lose the money. They're scared. They don't want to lose it. So they sell it and they hold on to everything. But that's actually how you lose in the long term, and that's how that wealth gets transferred to them. Because they profit off of our fear of losing. So keep that in mind. Your fear of losing money is making someone so much more rich. Keep that in mind. And I refuse to be on the wrong side of that transfer. So if you want a panic sell it to me because I'm going to buy it. You want a panic sell it to me. Listen, I'll make it happen for you. You know what I'm saying? But we're gonna close a couple things out. So to answer the question, should I invest during a market dip? Short answer is yes. But I'm gonna tell you this. If you have money that you don't need for the next 5 to 10 years, invest it. If you're investing money that you need for bills, do not invest it. That's not a good idea. And if you're planning to panic sell if the market drops more, if you're scared, do not invest. You're only setting yourself up for failure. But if you're watching this podcast and you want to grow with me, then yes, you see the market come down, invest that money. Invest that money. Not the money, not your bill money. Not the rent. Not the light bill. But that extra money that you got, that extra $5, that extra $10, that, that $20 bill that you just don't know what to do with, but you feel like it's burning a hole in your pocket, invest it. Not financial advice, but invest it. Because this is what's going to separate investors from gamblers. Investors have a plan to stick through it no matter what happens. And we continue to buy. We're going to stick to it regardless of our emotions, regardless of anything going on. Gamblers, they're going to react to every single price movement. They see something go down 5%. They're like, oh, whoa, now I need to sell this. No, we don't do that. We are investors. If you're following me, you are an investor. So when these dips happen, when market moves happen, we pay attention, but we stick to the plan. So during this market dip, yes, I invested. I bought a little bit more than I usually do because the market was down. The prices are looking lovely. And Netflix used to be $1,000 a share. They had a 12-to-1 split. It's $150 a share. It got down to $81. I want that. I need that. Like, you know what I'm saying? Netflix ain't going away. I know for sure. There is so many people watching Netflix, and they just purchased Warner Brothers. Yeah, they took on a lot of debt. Yeah, they may be hurting right now. So what about in 10 years? They'll be all right. At least that's what I think. So, yeah, I took my little 750 and I invested it during the dip. If it drops more next month, I'm still buying. If it comes up next month, I'm still buying. It doesn't matter. Whatever situations, I'm buying. But especially in the dips, I'm buying. That's all you need to know. But that's how you build wealth. You don't time the market. You put time in the market. First and foremost. Consistently, normally, you put your time in the market. Allow yourself to experience compound interest. Let your interest compound. Let your money compound over years, over time. You'll be fine. That's how you build wealth. That's how we're going to build wealth. So if you're with me, let me know. You're buying. You see things down, you're buying. Hey, shoot me a message on Instagram. Hey, the market's down. I just bought some more. We in here. I want to see it. I want to see that happen for you. Because I want you to experience when things go up and that account is looking right. Because you're going to be so happy. When you're like, man, it was down. And I bought it when it was cheap. It was red. Everything was red. There's blood in the streets. Blood on Wall Street. And now, everything's green. Everything's green bean. You know what I'm saying? And everything's chilling. So, yeah. That's how you build wealth. That's really all I got for you guys today. And I don't know what I'm going to do next episode. I had a couple ideas. But leave me some comments. Let me know what y'all think. What y'all want me to talk about. But I got a couple ideas, so of course. But for now, I'll see y'all later. Peace.